Hey guys, today we're talking high yield investing. Now, if you haven't seen any of my retirement videos, I am on plan to retire early. I am currently 44 years old and I would like to retire at age 55. Matter of fact, I had it at age 56, but I would really like it to be age 55. Now, if you looked at any of my retirement videos, you'll notice I have it broken down, and I'll go over them here real quickly. I'm going to have a year of savings in cash. Oh shoot, let me get that back. I am going to have 3 years of expenses in M1 Finance. This will be the first thing to get spent down in retirement when I retire at 55. I should have enough of a cash component that will take me to 55 to 56 without touching this. That's what I'm hoping. And what I invest in M1 Finance is a dividend growth pie, which is essentially 3 ETFs. And from age 59 to 62, I'm going to have another 3 years of expenses. And what I invest in my wife's Roth is an index fund and then high quality dividend stocks that yield between 4 and 6%. I break this rule a little bit. Some of mine are about 3. So I'd say 3 to 6% in there. And then my Roth, which will fund from age 62 to death, will give me dividend income forever, and I target a dividend yield of between 7 and 9%, and I would like that to give me about $1,000 a month at age 62. So along with that $1,000 a month and my wife's Social Security that we take at 62, let me move that over, we should get about $1,000 a month from Social Security, $1,000 a month in dividends, which should be enough for us. And then we wait until 70 to take mine, and then we'll have $2,000 a month coming from my Social Security. So between my Social Security, when we hit 70, me and my wife will be ballers until one of us pass away, because we'll be used to living on $2,000 a month, and then we'll bam, all of a sudden get 2,000 more. We'll double our income. Now that's my early retirement plan. What would be nice is if this whole thing, if M1 Finance, my wife's Roth, and my Roth at age 55 or age 56 gives me enough to live on without ever touching it, especially the Roths. That would be ideal, but I won't know. As we get further and closer along to it, I'll be able to make that determination of whether that's going to happen. And since this is going to be my second full year of investing in here in 2020, I'll know how my dividend income compounds over year, and then I can gauge how that's going to work. So what I'm looking at today are 3 investments for the high yield Roth, and I'm looking at 3 investments between 7 and 9%. And these are 3 different investing vehicles. Okay, and I'm going to go over 3 of them real quick with you. Number 1 is a stock, and that stock I am looking at is Invesco, ticker symbol IVZ. If you don't know it, Invesco is a huge investment company. They have some of the biggest, some of the most popular ETFs out there, like SPHD, QQQ. They acquired Oppenheimer funds here recently, or I think last year. They pay just under 7% dividend. They are kind of underperforming over the past 5 years, but if we look at statistics, They have a forward PE of only 6.65. And if we look at the analysis, and my favorite attribute is growth estimates of next year of 3.5%. So you have a 3.5% growth, 7% dividend yield, and me having a lack of financials exposure, I'm really looking hard at IVZ. Next up is an ETF. Now this is ticker symbol AMLP. This is the Illyrian MLP ETF. What this is are master limited partnerships that basically they are in the midstream. Well, how can I put it? They're in the transportation aspect of the oil industry. And they've been hit hard recently since 2015-16. Now, MLPs traditionally issue K1 tax forms at tax time. Now, that is a pain in the butt to file, and you cannot, well, I shouldn't say you cannot, you can, but you shouldn't invest in an MLP inside of a Roth IRA. So, this ETF is structured, this holding company is structured as an ETF so that it can avoid the K1. That's why its expense ratio is quite high, 0.85%, because they have to deal with all the accounting of it. So you can hold this in a Roth IRA. It pays just shy of a 9% dividend, and if you are you think there's a turnaround in MLPs, this might be a good time to get into it. Let's look at the holdings real quick. You know, it holds some big names. Energy Transfer, Magellan Midstream, Enterprise Product Partners is a really high quality one. Phillips 66, Plains All American Pipeline. So they only hold 22 companies. The top 10 has 75%. And that's one choice. 9% yield. But yeah, it's a contrarian play for sure. And last but not least is a closed-end fund. And I've made a video on this prior. And this is one of my favorite closed-end funds. Its ticker symbol is UTF. It is a infrastructure fund that has holdings in NextEra Energy, Crown Castle, American Tower, American Waterworks, Norfolk Southern. So it's a very diversified. This is basically a mutual fund. If you don't know what a closed-end fund is, a closed-end fund is like a mutual fund, except it is closed-ended. So a mutual fund will, if you want to buy into a mutual fund, you can buy in. There is no limit to the amount of shares that it can produce. A closed-end fund has a finite amount of shares, and they are very diversified. If you look at this, 40% utilities, 20% in industrials, 12% in energy, 10% in real estate, and some preferred and corporate bonds in there as well. UTF is one of my favorites. Now it does use leverage, and I'm not going to go too far into that, but leverage can be a double-edged sword. It can boost your return, but it can boost the negative return as well. And they use about a 27% effective leverage percentage, and that is kind of on par with most closed-end funds. But the nice thing about UTF, they pay a distribution of about 7%, and none of it is return of capital. In other words, they're not returning your own money back to you. And they pay monthly. And another unknown thing about UTF is they by far beat the S&P 500. And I'm going to show you a little chart here. Let's go to full screen. So this chart shows a $10,000 investment with dividends reinvested back in 2004, and also the same 10,000 invested in 2004 in the S&P 500. As you can see right here, your total return with UTF is 474% versus the S&P at 300. Your ending balance of $10,000 with dividends reinvested is $57,465 for UTF and $40,024 in the S&P. But like I said, when UTF uses leverage, and when I say it's kind of a double-edged sword, it'll amplify gains and it'll amplify losses. You would have had to have the nerve to, in 2008, when everything dropped, 2008, 2009, to stay with UTF and keep reinvesting the dividends. Whereas the S&P 500, everybody hated the S&P 500 because it fell 50%. It went from, I'm making up a number, $300 to $150 a share. UTF went from like $30 to like $5 a share. Now, I don't know how many of you would have held on, but if you did, it paid off nicely. And this is the picture of using leverage to boost returns, because it will also boost a negative return if that happens. But if you were to stay in and reinvest those dividends, and when the market turned, it shot off like a rocket, well above the S&P 500. So that's my take on UTF. It is one of my favorites. I didn't go over how to look at closed-end funds very well. I might do another video of that, just to give you the basics on closed-end funds and how to look at them. And but those are the three I'm looking at for my high-yield Roth. I'm really leaning toward IVZ because I don't have any financial exposure. My second choice would be UTF because I believe that they have quality managers. They pay a 7% dividend and they pay it monthly. My last choice will be AMLP. That's probably the riskiest because they are very undiversified, where they only have 22 holdings. But it's probably the higher reward play at the moment. So I'll make my decision, and I'll probably have an update for you come the beginning of February. So hope you enjoyed. Please leave me like, share, subscribe down below, and we'll talk to you later. Thanks. Bye-bye.